Most people think a wealth disaster begins when the market crashes. I do not. I think it begins much earlier, in the part of the cycle where paper wealth still feels safe, oil still feels abundant, central banks still sound composed, and ordinary investors still believe they have time. That is when the real danger is highest, not when everyone is already scared, when almost nobody is. Because by the time the panic is obvious, the structure is already changing under your feet. That is why I want to begin with a harder sentence than most people like to hear. When energy breaks, paper wealth burns first. That is the mother line of this whole story. Not because gold is magical, not because every war ends the same way, not because every recession turns into the 1970s, but because when the world's most important energy artery becomes unstable, the cost does not stay in oil. It moves through the entire system. It moves through currencies, rates, consumer prices, asset valuations, confidence, retirement accounts, and the fragile assumption that most modern paper assets can keep compounding smoothly while the physical world is being repriced. That assumption dies faster than most people think. And if you are holding the wrong things when it dies, the damage is not theoretical. It shows up in your future. I have lived long enough to know that markets do not primarily reward people for being loud, ideological, or even particularly clever in public. They reward people who recognize the regime change early enough to stop treating the old playbook as permanent truth. That is what 1973 was, a regime change, and that is what this moment could become again. Most people remember 1973 as an oil story. That is too shallow. It was an energy story, yes, but more importantly, it was a money story, a rate story, a paper wealth story, a complacency story. America had built a way of life on cheap petroleum, large cars, long highways, easy assumptions, and the belief that supply would remain open because the world had grown used to it. Then the supply was politicized. The tap was turned. Prices did not just rise. They redefined what stability meant. That is what energy shocks do. They do not merely make things expensive. They expose how much of the economic order was quietly subsidized by cheap fuel. People think of gas prices first because gas is visible. The grown investor thinks several layers deeper. Transport costs rise, food costs rise, fertilizer costs rise, manufacturing costs rise, shipping insurance rises, consumer confidence weakens, inflation runs hotter than policymakers want. Central banks lose room, stocks reprice, bonds disappoint, households feel poorer, governments respond late. That is the chain. And if you do not see the chain, you will always arrive emotionally after the price move already did the damage. Let me tell you why 1973 matters so much to me. Not because history repeats perfectly, it does not, but because it rhymes through mechanism. Before the embargo, America felt strong, mobile, oil-fed, and confident in exactly the way late-cycle societies often do. Cheap energy had become part of the national psychology. It was not just a commodity, it was an assumption. When an assumption this basic is shattered, the economic pain is only half the story. The other half is that people suddenly discover how much of their wealth was built on a cost structure that no longer exists. That is what the public learns too late in every energy crisis. The numbers look manageable until the physical world reprices. Then suddenly a portfolio full of solid paper claims begins behaving much less solidly than its owner was promised. This is why I say paper wealth burns first. Paper wealth depends on the continuation of a pricing regime, a stock certificate, a bond allocation, an index fund, a retirement statement. All of these can look wonderfully reassuring while the underlying world remains orderly enough for valuation assumptions to survive. Change the energy regime, push inflation up, force rates higher, weaken confidence, and the very same paper assets begin discovering what kind of environment they were actually priced for. That was the real violence of the 1970s, not one number, a whole repricing of normal. When oil quadrupled, most people did not merely face higher gas bills. They faced a different economic universe. The stock market did not suffer a polite correction. It suffered a humiliation, adjusted for inflation. It took an agonizing stretch of time to repair the damage. Many people who believed they were prudently invested discovered they had really been exposed to a paper system unprepared for a physical shock. That distinction matters enormously, and it is the exact distinction most ordinary investors are missing today. They hear Middle East conflict and think in headlines. I think in plumbing. The Strait of Hormuz is not just a talking point for television panels. It is a choke point in the literal bloodstream of the industrial world. If enough oil cannot move through it, or if moving through it becomes dangerous enough, expensive enough, or uncertain enough, the market reprices the world before the public has finished asking whether the route is officially closed. That is why I do not need to wait for a dramatic formal announcement to care. I care about risk pricing, insurance costs, route avoidance, tankers, bunching up, inventory, hoarding, military escalation. The market does not wait for certainty. It prices probability. That is the first mechanism. The energy break begins as a probability shock. And once that happens, the second mechanism arrives immediately. Inflation stops being a policy discussion and becomes a lived condition. This is what people still underestimate. They treat oil as though it were one sector. It is not. Oil is embedded in food, freight, chemicals, packaging, heat, cooling, manufacturing, agriculture, and every chain that delivers normal life into your house. So when energy rises sharply, the whole economy does not merely feel pressure. It becomes more expensive to operate at almost every level. The household feels it in groceries. The business feels it in margins. The government feels it in political pressure. The central bank feels it in its loss of flexibility. And the investor should feel it in the hierarchy of assets, because this is where the old paper hierarchy begins to fail. Most people own some form of paper prosperity, a 401k and IRA, a portfolio tilted toward equities and bonds, a target date fund, a broad market exposure that worked wonderfully when inflation was tame, rates were manageable, and energy remained a line item instead of a force. Fine, there is nothing inherently foolish about paper assets. I own many of them myself through broad ownership of businesses. But paper assets are not invincible. They are context dependent. And in an energy shock that feeds inflation, the context changes. That is why the stock market collapse of the 1970s matters so much. Not because all stocks are always bad during crisis, because broad paper claims tied to a stable cost world suddenly had to be repriced for a much harsher one. Most investors were not prepared for that. Now let me introduce the third mechanism, government delay. This one has been true for longer than most political careers last. Governments are almost always late to real economic regime change. They do not move when the structure first cracks. They move when the pain becomes socially undeniable. By then, the market has already repriced far more brutally than official language is willing to admit. In 1973, America did not respond with calm structural foresight. It responded with gestures, rationing, symbolism, and eventually larger institutional changes after the damage had already become visible. That is the rhythm of governments in crisis. They are mop crews pretending to be architects. Their responses may matter eventually, but they almost never arrive early enough to preserve paper wealth the way ordinary people imagine they will. This is why I never wait for government rescue as an investment strategy. Not because I distrust all policy, because policy is almost always downstream of market pain. By the time the state acknowledges the problem fully, the first wave of repricing has already happened. That is what people keep getting wrong right now. They think emergency reserve releases, official statements, central bank language, and public reassurances are solutions. Sometimes they are temporary cushions. They are almost never cures. If the problem is a live energy artery under geopolitical stress, then dumping reserves is a bandage. It buys time. It does not restore trust. And trust is what the market is really pricing. Now, let me talk about the fourth mechanism, because this is where the gold story becomes real. Gold is not mainly a commodity in moments like this. It is distrust made liquid. That is how I think about it. When the public order looks stable, gold seems old-fashioned, inert, unproductive, maybe even embarrassing to the most modern parts of finance. But when money itself becomes suspect, when inflation threatens to outrun policy, when war begins rerouting energy, when governments are late and paper wealth is being repriced, gold stops looking primitive and starts looking like what it has always been in history, as rougher chapters, monetary insurance without a CEO. The 1970s proved that with brutal clarity, gold did not merely rise, it reset. That is the right word. From its prior anchoring point to a much higher understanding of what a paper dollar was really worth in a world where inflation, energy, chaos, and political weakness were all rising together. That move was not a cute trade. It was a judgment on money, a judgment on trust, a judgment on the durability of the paper order. That is why I refuse to talk about gold as though it were just another line on a chart. A chart shows price. It does not show why people suddenly need an asset that does not require an earnings report, a refinancing window, a dividend policy, or a central banker's permission to remain what it is. Now, that does not mean gold is magic. I dislike magical thinking wherever I find it. Gold can fall, gold can stall, gold can be a poor holding in the wrong structure or at the wrong size. But in true inflationary energy shocks, it often does something paper promises struggle to do. It survives the repricing of the currency itself. That is its job. And silver, which many people misunderstand even more than gold, becomes the fifth mechanism. Silver is gold with nerves. That is the simplest way I know to say it. It is monetary enough to benefit from distrust and industrial enough to be pulled by real physical demand. That combination can make it astonishingly powerful in the right part of the cycle and absolutely vicious if held with the wrong temperament. In the 1970s and in later periods of metal strength, silver did not just follow gold politely, it often overshot it. That is what leverage inside a physical metal looks like, but leverage cuts both ways, so I do not romanticize silver. I respect it. Respect means understanding that a more explosive asset also requires more discipline, more structure, and more emotional steadiness. Many people hear stories of silver outperformance and translate them into recklessness. That is not wisdom. Wisdom is knowing why a metal with both monetary and industrial demand can move violently in a regime change and why it can also punish the weak hand faster than gold does. That is why I think of gold as the financial fire extinguisher and silver as the same extinguisher wired to a pressure tank. Useful, powerful, potentially dangerous in the hands of a fool. Now let me introduce the sixth mechanism, the signal before the signal. This one matters because almost no one watches it seriously enough. When hard assets start moving before the public fully understands why, they are telling you that someone somewhere is already repricing the future. That is why I care so much about the gold-oil relationship. It is not some mystical formula. It is a ratio that tells you what one real thing will buy of another real thing. When gold begins outrunning oil in certain ways, the market is often sniffing out monetary stress before the public sees the full energy damage. When oil then catches up violently, the ratio tells you the two deepest systems of fear have begun to collide: monetary distrust and energy shock. That is not a retail story. That is an institutional story. The public watches headlines. The serious money watches relationships. That is why I say somebody always knows before the crowd knows. Let's put a secret memo in a dark room, because professionals, sovereigns, and hard asset buyers live closer to the plumbing than the public does. They do not wait for the news to become emotionally legible. They watch inventories, freight spreads, rates, flows, custody, and real-world bottlenecks. Now let me tell you what complacency does in environments like this. It turns a manageable warning into a disaster. That is the seventh mechanism, and perhaps the most important of all. People were complacent before 1973 because oil had been cheap long enough to feel natural. People were complacent before the housing crash because easy credit had lasted long enough to feel natural. People were complacent before technology bubbles burst because upward motion had lasted long enough to feel natural. The most dangerous word in finance is not risk. It is normal. Normal is what lulls people into holding the wrong structure at the wrong time. Once cheap oil, low inflation, strong paper assets, and easy assumptions become normal, the public stops building defenses, they stop holding hard assets, they stop asking whether the state can really stabilize the shock, they stop imagining that a pension, a 401k, a classic 60/40th portfolio, or a tidy retirement chart might be less bulletproof than they were told. Then reality arrives, and reality always feels rude to the complacent. This is why I do not care whether somebody thinks an energy shock probably won last. That is not the point. The point is that if the world must reprice energy risk sharply enough, then the damage to complacent positioning can happen long before the crisis is resolved. This is what the ordinary investor misses. He keeps asking whether things will go back to normal. The informed investor asks what the shock has already revealed about the fragility of the old normal. Those are two very different mindsets. One waits for reassurance. The other studies repricing. Now let me say something directly to the person with a retirement account, because this is where the story becomes personal. A 401k full of broad paper claims is not foolish by default, but it is incomplete if it assumes every future will resemble the last decade of low stress. Central bank managed complacency. If the coming years include a real energy shock, hotter inflation, late government reaction, and a repricing of trust itself, then a retirement structure with no hard asset ballast becomes vulnerable in a very specific way. It is vulnerable not only to market volatility, but to the possibility that paper wealth keeps losing real purchasing power, even when nominal balances eventually recover. That is the part many people never fully understand until too late. A chart can come back, purchasing power may not. If the market takes years to recover while inflation keeps chewing, your statement may one day look healed while your life remains poor. That is a brutal lesson, and it is one the 1970s taught with incredible cruelty. That is why I want people to stop thinking only in nominal terms. If your retirement account loses deeply, then regains ground over many years while the cost of life has moved radically higher underneath. You were not made whole just because the line on the chart came back. You were diluted. That is what inflation does to paper recovery. Now let me tell you the deeper opportunity, because I do not want to leave you trapped in warning alone. Every serious crisis creates bargains. The public hates hearing that because it sounds cold. Fine, it is cold, but it is also true. In 1973 and 2008, in every hard repricing cycle, the people with dry powder, hard asset awareness, and emotional steadiness do not merely survive. They get to buy what weak hands are forced to sell. Distress creates inventory, panic creates price, price creates asymmetry for the prepared. That is why I refuse to moralize all downturns as pure tragedy. They are tragedy for the unprepared, they are transfer for the prepared. Again, not to the same people. That distinction is the whole game. So when I look at this period, I am not asking whether fear itself is an opportunity. I am asking where the repricing is moving, which paper claims are most exposed to the energy and rate chain, which hard assets remain underowned relative to the seriousness of the shock, and whether the current complacency in ordinary portfolios is still wide enough to create transfer later. That is how I think. It is how I have always tried to think. What is being repriced, who is forced, who has cash, who has conviction, who owns the thing that does not need permission to remain valuable. Those are useful questions. Now let me make the identity flip explicit. The average investor sees an oil crisis and asks, will stocks bounce? The steward asks, what kind of wealth burns first when energy breaks? The average investor sees gold moving and asks, is it too late? The steward asks, what role does this asset play if money itself is being judged? The average investor waits for the government to fix it. The steward assumes the government will be late and structures accordingly. The average investor wants comfort. The steward wants protection first and opportunity second. That is the shift. From spectator to allocator. From headlines to mechanisms. From price watching to structure watching. And once you make that shift, a great many things stop being confusing. You stop being surprised that governments are reactive. You stop being surprised that cash gets quietly destroyed in inflationary periods. You stop being surprised that gold and silver attract serious flows when paper wealth is under physical stress. You stop being surprised that people with hard assets and dry powder emerge from crisis with more than they had before. That is not luck. That is preparation meeting regime change. Now let me leave you with the coldest lesson of all. The investors who got hurt in the 1970s were not generally stupid. They were positioned for a world that no longer existed. That is all a major crisis really does. It reveals that yesterday's portfolio was built for yesterday's rules. If you do not update your structure before the crisis fully announces itself, the update gets done to you by price. I would rather do it myself. That is why I care so much about energy, money, and hard assets. Now, not because I want to live in fear, because fear is useless. I want to live in structure. Structure means understanding that a crisis in oil is not only a crisis in oil, it is a crisis in assumptions, in rates, in inflation, in policy credibility, and in the real purchasing power of paper wealth. And if you remember nothing else from me, remember this. When energy breaks, paper wealth burns first. That is the old lesson. It is becoming the live lesson again. And the people who come through this period with the most dignity will not be the ones who watch the most news or repeated the most slogans about diversification. They will be the ones who recognized early enough that hard assets, low complacency, and real preparedness matter. Most when the physical world starts rewriting the terms of the financial one. That is what needed to be said. And now you know where the real fire begins.